Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, well, it's the man himself, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing pretty good. How's everything going in your world?
Oh, fantastic. You know, we have the Old Capital Conference that was just announced coming up here in October, but coming closer to here in April, we have the 17th and 18th, the DFW Multifamily Field Trip. Again, that is where it's a day of classroom to talk to folks that maybe have never invested in multifamily apartments, to kind of have them give just an overview about what's going on right now, what's gone on in the past, maybe talk a little bit about history, talk a little bit about what the future is going to lie at in multifamily investing. The second day, we're going to go out to take a look at A, B, C property types throughout the Metroplex. We're going to jump on a bus and we're going to take you all around DFW to kind of show you, feel, smell what a Class A, B, C property looks like. So we're excited to have you come out with that. Go to oldcapitalpodcast.com to RSVP. We're only taking 50 people on the bus. That is the most we can take. And we want to have it just small, and you'll have a chance to meet the professor, of course, and then Mr. Michael Becker. So we're excited about that. Michael, you guys are doing something over at SPI that I think is really fascinating. Talk a little bit about your event to raise money for.
Yep. So I'm on the board of a good charity here in Dallas called Vogel Alcove that helps homeless children in the local community and get them, stabilized and hopefully get their parents kind of rehabilitated and back into kind of normal housing. So we're doing something called Par for the Purpose. It's on the 15th of May, and it's at the Top Golf here in Dallas. So it's good charity. Love anyone that's interested in kind of joining. There'll be a bunch of brokers and other apartment owners in the local Dallas-Fort Worth area. If you guys are interested in kind of networking and supporting a good cause, I think the easiest way, Paul, is actually probably send us an email at support@spiadvisory.com. We're kind of sold, I think, a little bit over half the ticket. So got maybe 25 spots available. So just support@spiadvisory.com and we can send you some information about it.
Great things that you guys do over at SPI. In the podcast today, we have a friend of ours that has been on the podcast once or twice or three times. We really enjoy speaking to Charlie Young with Madera. Charlie is not only a great guy, a fun person to be around. He has a lot of life in him that you'll see when we start to talk with him. But he owns thousands of apartment buildings and units throughout North America, more specifically in the Dallas-Fort Worth, Austin, San Antonio markets, but also to making positions on the East Coast too. We'll talk a little bit more about that, but I want you to have a chance time with Charlie, kind of understand what his philosophy is. If you are a new person into multifamily investing, Charlie's going to be talking about college level things. So if you're brand new and you're a freshman, this is freshman high school algebra, he's going to break it down to simple language for you so you can understand and how you can get to be where Charlie is, hopefully in the future. So Michael, I'm going to turn it over to you and let's talk to Charlie Young.
Yeah, Charlie, maybe just kind of start with a kind of a brief bio on yourself for those that are unfamiliar with you.
Yeah, good to be with you guys today. So go back in time. I'm now 34 years in the business. Bought my first 24 units with two other guys in 91, bought another 24 units across the parking lot from it. A few months later, that was out of the RTC. I went pro in multifamily in 96, did a lot of management. That's where I cut my teeth learning how to manage and just the basics of operations. Did that up through till 08. And at that point, the partners I'm with now decided it's time for us to go do our own deal. So we sponsored our first deal in July of 2008 in Baytown, Texas. A good value add. Wonderful time to start your career. The hurricane literally and financially comes through in September of '08.
Yeah.
And it was a really rough start. So from there up to now, we've bought, I think, about 120 apartment complexes. Started with pure value adds and worked our way into just about every other spectrum of multifamily, and sold, I think, 77 of those to date.
So how many units roughly have you purchased? So what do you guys own today?
Today we own 11,000. I think we bought close to 25,000 over time.
Yeah, good. Well, appreciate you spending time and sharing your wisdom. I thought, we'll kind of focus the conversation today, first and foremost, kind of just on the state of the market and more specifically, it's hard out there raising money. Everything's been a grind. I know you've been on the road just having meeting after meeting, which is
Yep.
essentially what I've been doing pretty much all year as well. Just trying to find new, stay in front of our current investors and giving them, frequent communication, seeing who's still active and who's not, and then trying to expand the roster and, different areas that we haven't maybe done before. It's kind of what I've been focused on. I think you've been doing pretty much the same thing. So kind of what's your read on the market? Kind of maybe we start just on investment sales and where, volume and pricing and what are you seeing out there versus, the recent past?
So my take is we're sitting in an environment that it's mostly clearing price of assets, and so there's not that many assets that are out there. You're hearing that the brokers talking about doing BOVs and people getting ready to go, but in general, there's not an awful lot of product that's in the market. And any of it's there is there for a reason. We wouldn't sell any of our deals today unless we had to, because it's all a clearing price. But I think that's the good news for today is I truly believe we're living in a window, and I don't know how long that window is, but it's a window that a buying window that will. Is it 6 months? Is it 9 months? I think a lot of that has to do with where the Fed decides to go and when do we get some stability in the 10-year. But the longer it goes, there are going to be more people that have to get out for one reason or another. Not all of it's capital stack reasons and are non-performing assets. And so we at Madera are gearing up right now to really take advantage of whatever comes available and be ready to move.
And so that we talked a few times here earlier this year when NMSC we hung out a little bit, and you came out to my ranch a month or so ago. We had a few glasses of wine out there and maybe tequila or two.
And
campfire
and some brown water.
And you were explaining how historically Madera has been in two markets, by and large, with maybe a couple one-off deals here or there. You've been in Dallas Fort Worth and you've been in Houston, and you recently told me how you guys hired a few key team members or partners and are really looking to kind of take it to the next level. So maybe kind of talk about what you're doing and then why are you making those moves?
So I cut my teeth in Texas. And so I feel like I know value as good as most operators like yourself and a number of our other friends that have been around for a long time in Texas, but not in other parts of the country. And a lot of people go, that automatically go, oh, the Southeast. And that is a primary corridor. But I said, I'm not going to go out there because I don't know value. I don't know the nuances. But two thoughts, just the thought that this is the opportunity, I believe, of call it a generational opportunity to be able to buy really good deals below replacement cost. But also you get investors who are saying, I want to get diversification. I've got 11,000 units and the majority, all of it is in Texas and the majority of it is in Dallas, Fort Worth, or Houston. And so they would like to see some diversification. And then if you're going to end up with some institutional investors, they also prefer to have diversification and not be, stockpiled all in one area, particularly if they're going to be programmatic investors with you. So for that, we, over a long period of time of relationships, I've said for years to any of the people that I've spoken to or talking just in general, that relationships is still a huge part of this business. And so we've had some relationships that have matured and gotten to a point where we could be actionable on them in 2024. The first one is James Kane, formerly with Starwood, 19 years as head of asset management for Starwood. At the peak of his, he was overseeing 100,000 units all over the country. They would drift between 60,000 and 100,000, depending on what they're buying and selling was. And he sold probably 20 billion of assets. It's just a wealth of information. And so, long 3-year conversation with James about the prospect of coming over and partnering with us. And we made that call close to a year ago. And James is going to join in the middle of June. And he will give us a depth in these markets that I don't know. And so people go to the Southeast, and I go, yeah, but it's easier to say where we're not going to go. We're not going to California, Oregon, Washington, Illinois, New Jersey, New York, and Massachusetts, or any place that is not landlord friendly. Sure. So that leaves a lot of open space. Arizona, Utah, Idaho. There's going to be a lot of places that are going to have really good growth because of the stupidity of some other states, and politically, policy-wise, that's going to be beneficial to look at. And so he will come into that role and be able to help on value and setting up the operations in those particular markets. We also have had a relationship for a number of years with Jay Parsons and some of the Waymaker guys. And this year, we made a decision to bring all of us together. We had been partnered in one way or another, but everybody's going to fly underneath the Madera flag. And Jay, after 15 years with RealPage and as their chief economist, is now going to come over and be the head of investment strategy for Madera. And so whenever we're looking at Columbus, Ohio, or wherever it may be, we've got a super meaningful resource to put the analytics to it that'll help us in being able to have the communications with investors and the confidence in our underwriting.
So it feels like you built a supercar here, or in the process of doing that, and the fuel of that is cash and equity, right? So
yeah,
pivoting, I guess, to that kind of conversation and some of the ones we kind of had offline. So what are you doing? What are you hearing? I know you've been all over, just meeting after meeting. So what's the takeaways here?
2023 was about as miserable of a year as it could possibly be. We did 3 deals. The extent of 3 deals, they were big deals, and actually 4 deals. And the struggle could not have been any harder for me, with all of the time and experience that I have with it, that it could be for somebody that's just starting out. And so during that period, I started going to family office conferences and I was in Boston, Dallas, a couple other locations, Palm Beach, San Diego. And I took one trip to Amsterdam, and to go see if I could prize some European money out. And the first thing that they asked me, they go, "What's your vehicle?" And I said, "A Tesla." They go, "No, what's your investing vehicle?" Of which Madera does not have an investing SPV vehicle set up for these people at this conference to invest offshore and come over to the States. Still a fascinating conversation. I enjoyed the 2 days, but absolutely goose egg out of all of this. And I also, in the latter part of last year and the first part of this year, have been working my tail off on institutional investors, going, if this is the time, I mean, it's now. If you're going to find a good deal, it has to be right now. And I go, okay, surely we can find some people that would want to get on board with us for that. But I keep hearing they want a 16 or an 18 IRR for a value add, and maybe on a core deal, a mid-teens. And with the type of underwriting that they want to put out, it's impossible. And so have had some great conversations. People said they'd like to work with Madera, but even with a deal that we've recently got awarded, that's a phenomenal deal. It just didn't check their box. And so we've expanded our IR team, and we have been shaking the trees really hard on referrals to get new investors. So we started out in 07 with 08 with 7 investors, and 5 of those are still invested with us. 2 of them have passed away. And we're now up to about 1,800 high net worth individuals as investors. So I'm spending an awful lot of time every day on trying to find new investors and looking for acquisitions.
So you mentioned that you closed 3 or 4 transactions in 2023, and you said they were large deals. Give me an idea what large in your mind is.
We bought the Cirque Apartments in Victory Park of Dallas, the JP Morgan property that they needed to get out of. And that was ended up being 104 million, 413,000 a unit for a high rise.
That's a lot. Keep going, Mike.
That's a lot.
So all the conversations. So are your takeaway, you're still going to talk to the institutions, but they're not ready to go, or you're going to focus on your 1,800 people and any referrals off of that to fund the deal that you just got awarded? Or
so the thought of it for me was, there were 3 deals in Houston here recently that were on the market: the Tinsley, the Virage at Memorial, and Gables River Oaks. All really good assets, but there's no chance that I could take all 3 of those down with just our high net worth individuals. Mm-hmm. So I'm circling the wagons, trying to see what interest there is, and it just doesn't materialize for anything other than our high net worth. So we get awarded the Virage at Memorial this past week, and that's a $28 million raise. And so we're going to plow into that. That's going to hit the market tomorrow. And we will go full guns to get that filled up as fast as possible. It's got such a huge story that I think we'll be successful very quickly on that. But for us, we'll have to go knock that one down to be able to go sign up for another one that's a 25 to $50 million raise.
And so you're just going to do it the old-fashioned way? We're not
old-fashioned hand-to-hand combat.
And then how are you going to buy your deal in Columbus, Ohio, or Boise, Idaho, or Atlanta, Georgia, wherever you're going to buy? Is that, you envision that being institutional partners? You think those guys are about to get a little more real in their expectations, or you think you're going to have to keep grinding it out the old way?
I'm hoping that we get the family office side of it is something I think that's going to take time. Those are people that are just, we had a meeting. That's not going to move immediately. And so I'm still perspective that we know we got good product. We know we got a track record. And so if you want to get into multifamily, we're as good a group as anybody to get in with. So at some point, if they want multifamily, that we're a good option. So I still believe in that. the institutional world now knows who Madera is and knows that we're pretty good operators. So I think there will be a place in time that somebody wants to get on board with what we're doing.
Well, that's
And
not today.
it's not today. I was in New York City 2 weeks ago having meetings, and they're just puckered up, and their underwriting is just not reality. So we'll keep working it off, and we'll just see where it lands.
Do you have a sense of when that's going to change? Sorry to cut you off, Paul. Do you have a sense of when that's going to change?
So I'm going to guess like everybody else. So the Fed's going to have to give them some clear direction. Well, one of the things that they need discovery of pricing. And there is no discovery of pricing because there is no pricing out there. They need to know what prices and cap rates are, of which there just have not been any. They need stability in the 10-year. And all of that probably hinges off of what and when the Fed decides to provide some clarity for them, because we started December where everybody thought that the Fed was going to cut in March, and then the prints came out hot in January and February. That got moved back to June, July, and it's all over the map. So when things are all over the map, those people have no interest in engaging. But they have an awful lot of dry powder sitting on the sidelines ready to go.
So do you think it's first cut they go? Do you think the election's going to be another excuse? Do you think this bleeds into Q1 25 where they start going? You have a read?
Everything I've thought has been an absolute lie coming out of my mouth.
You would have thought it happened by now. So would I.
I will tell you this. My preference today is hold it up through the end of the year. Now that's just as contrary as real estate people would have it to go. But if that leaves the window open a little bit longer and shakes a few more tree leaves off the tree, then so be it.
Yeah. My read, and I'll let Paul ask this question, is it seems like it's a herd mentality, right? The first one's got to go, and then there's FOMO, and they're all going to go. And so you would think it'd be the first cut, but you had a recent conversation with JP.
Well, so let's go back to those deals in Houston. So the one that got awarded right before the barrage was the Tinsley that CBRE had out, and they had 34 people that posted LOIs, and a lot very bunched up together. And there were an awful lot of institutions that are big name institutions that were in the mix. There were also developers. The developers' equity is telling them, go find quality assets at a significant discount to replacement because you can't build it for that. And so that was the scenario for the Tinsley. And for our deal, the Virage, it was the same deal. I think there were 40 people that posted LOIs and very competitive.
But was it 4 at the top and 36, 10% below?
There were a lot that were bunched up together. And there were some very large developers that were in the mix. But some of those folks had known institutional equity that they were not going to budge any further. And so that's it. They're out, which is kind of nutty to me in some regard. Let's say the difference is $250,000. That's a rounding error on an $82 million deal.
Yeah. But
they get stuck in their spreadsheet to this and this only, as opposed to the bigger picture of it. So they're wanting to do something, but it's just not yet.
I want to kind of talk a little bit going back to the individual investors. I mean, you guys have just been talking about the institutional investors, but the individual investors that are investing into the deals like what you, Mike, and what you, Charlie, go out there and do. Again, as a general partner, that you really your job really is two things. One, find new opportunities to buy, and then find new investors. So that's really your two main jobs. So going back into finding those those investors, what is the story being told? And Mike, and you can comment on this too, but Charlie, I'm looking for your insight. Is it the story behind the opportunity to buy that the investor gets comfortable with, that or is it something concerning like the IRR? What are they looking for? Do they have to hit a certain threshold to invest in with you guys, that they're looking at 11, 12, 16% rate of return to just to get excited about this market? Or is it your long-term experience? Do they get comfortable that we're putting money in with Madera because Madera has done 110, 120 different apartment buildings that they bought, and or like SPI's done this much. So maybe you can talk a little bit about when you're out there with your hat in the hand looking for more money to these individual investors. What are you guys talking about?
You going first, Beck?
I'll let you do it.
Okay. So it's a story. Investors will, if I sit down with them, they'll go, what do I need to ask that I haven't asked? I said, always with a Madera deal, there's got to be a story. We're never buying something just for basic multifamily underwriting. There's got to be a bigger story behind it. And so the example of the property that we've recently had awarded, it was purchased by the seller in 2014 for $106 million. It was under contract in March of 22, right before the world fell apart, for $110 million. Interest rates start rising. The buyer blows out. The seller is just in a position now. The property is 95% occupied. It's doing very well, but the seller has a mature loan maturity, and also it's one of the last deals in the fund for a that's got to get closed out at some time. And so for that, the seller says we're willing to meet whatever the market pricing is, which today is a clearing price. And so we'll buy that for $82 million. That's a big story.
Yeah, no, I concur. Everyone buys a story, Paul. I think the other thing is what's going against us is, a lot of the money that Charlie's raised, a lot of money I raised, a lot of it's been from velocity of deals. You buy a deal 2-3 years later, 100,000 turns into 200,000, and then the investor gives you 100,000 for 2 separate deals, and we do that for a decade or better, and kind of started adding up after a while. That stopped. But what we do have going for us is Charlie was one of the largest owners in Texas, and as am I. And I beat him. I did 5 deals last year, and he did 4. And I was probably number 3 in the state, and he was probably number 5 in the state. And that's crazy to think a state with 2.5 million market rate multifamily units at 5 transactions will get you in the top 5 of the state. I mean, that's how little volume there has been recently. So there's the alternative. If you want to invest at today's pricing, I don't have 100 competitors anymore. I got Charlie and maybe a couple others, and a lot of guys are just pencils down. So that's been, a little helpful, on the margins for sure. And, you got to buy the story, and you got to be able to sell conviction. And obviously they trust the, firm like ours or Madera to give you the money, or they wouldn't even be talking to you if they didn't have, faith and trust in your abilities and ethics and things like that, Paul. But I think, yeah, Charlie's saying it's I've been talking, and I think today the takeaway is it's like, I try to be pretty modest and pretty even keeled, and, shit can go wrong in this business, and it usually does. And just how you react to it and solve it. But, it's kind of banging the ring on the table moment where, like, if you can't get excited about today and right now, I don't know when you're going to get excited. I mean, that's kind of
you're not really wanting to buy multifamily if you're not excited about today.
Yeah. And the moment the Fed cuts and the institutions say, okay, hey, we're off the sidelines, we're going to go, it's 5-10% up overnight. Like it's just the market gaps up 5-10% overnight, because we're, 12 months from now, 15 months from now, the supply story is a completely different picture. And, we're going to see rent growth, and we're going to see probably outsized rent growth in second half of 26 and 27. It's not going to be 2021, but, it's not going to be 3%. It's going to be 5%, 6%, 7% until supply picks back up. That's what I'm confident in. I'm the hill I'm dying on, you know. That's what's gonna happen, and it's just supply and demand, and we do not have a demand problem. There's a shit ton of absorption going on. We just are way overbuilt and for the short run, and that's the opportunity.
Can you talk a little bit more about IRR and what the market is saying right now that I have $100,000 in my pocket? Do they have to have 11%, 100%? What is the rate of return realistically these days? Everybody's been making this 22 to 25% for the last couple of years, and all of a sudden we've seen the brakes come on distributions, but everyone's talking about IRRs. And then is anybody is doing preferred returns right now? Just maybe accruing a number. What are you seeing in the market right now? And I'll ask this to Charlie.
Trying to think how to best answer that question. We put together a deal and we put together the best underwriting and we go, yeah, we feel like that's good. So the deal that we're working on right now over 5 years is close to a 13 IRR. I honestly think it's going to be better than that, but
Sure.
For us, you need to underpromise and overdeliver. And so for our 77 that we've sold, I think we've got 5, maybe 6 that didn't do exactly what we wanted them to do. That's how you get people to return as investors with you. So just do it. I've always said, if somebody's looking at whatever the number is, if you're happy with that, I think you're going to be even happier when we get through. That's the way the underwriting needs to be set up. And so that's all I can do is just put it out there in that format. And with a good story, last year we bought a deal in the Houston Med Center that was a wrap. We bought it for $207 a door. It's a 2015 vintage. The developer had owned it since the beginning of construction 10 years ago. And the rents were sub $2 a foot, super high occupancy. The real comp is a 2014. Ours was a 2015. The comp was a 2014, a block away, getting $2.45 a foot of rent. I go, I can go get that. It's there to be had. And then, oh, by the way, right across the street is a research park that when it's fully completed is going to have 23,000 jobs. It opened up at the end of 23 with 2 of the buildings, and they're building 2 more right now. It'll take 5 years to totally flesh that out, but it's impossible, just about impossible to build something in the medical center, and an awful lot of demand. So they got 110,000 jobs in the medical center. In the next 5 to 10 years, it'll be 200,000. That's a big story. We're going to win. That is going to win. There's no way else. So you just put together the underwriting, present it, and go. Anybody come into agreement with that?
Yeah, because it's $260 a door or more to build that thing today, right?
I think it'd be more than that down there.
Yeah.
Mike, you guys don't do preferred returns to your investors, and why is that?
We started out, didn't do it, didn't know any better, and just kind of kept the same structure, kept it simple. That's kind of what it is, and have a fair deal. We don't graduate our waterfall up either, so probably would have made more money with the pref waterfall, graduated waterfall, and I'm sure Charlie probably has a similar story. He started doing a structure and it worked and never changed. Just kind of kept it the same.
Yeah. So you go through good times, you go through really hot times, and our investors know what they don't have to recheck as to what the agreement is. And there were times that it was super, super hot. And yeah, should we have maybe gone for some more money? Quite possibly. But then there are times like this that are not. And so just trying to keep consistency. I'll guarantee you we haven't made as much money as some other people, but we're happy with where we're at and what we're doing, and our investors are very happy.
Mike, talk a little bit, and then I'll let you have the microphone. Talk a little bit about buying distressed assets these days? Are they calling you to try to fix a lot of problems? Maybe the servicers or the brokers out there. Are those deals available? I mean, I've seen a number of deals pop up, whether it's Houston or it's in other parts of the country. Are the distressed deals trading?
I haven't seen
Yeah.
a ton trade. I mean, it's a sub segment of workforce housing, bridge debt, in the hood. I mean, that's kind of where most of the stuff is really distressed. And then there's some other partnership issues that aren't quite as, distressed, but they'll probably make it through. And those deals are below debt basis, and lenders are still asking par for their notes. So no, it really hasn't cleared yet. You're seeing the kind of leading edges of that. So that might change. And I guess my current view is I thought it would have happened by now. If you would ask me the same question 15 months ago, I thought it would have happened by now, but seems like maybe you'll see a little more volume of that at the end of the year, the beginning of next. You've seen a few more of these come on the market, but I think they're still above debt basis. So these are the deals that are at least, north of 90 occupied and, don't have a ton of physical issues. They're just, bought at a bad time and they got a maturity and they got to go. So maybe they get debt basis or above to kind of clear it out and move on. The stuff that's like really messed up, I won't name names, but some of the groups that were real aggressive at the wrong time. I mean, they're just their bodies are dead. They're just zombies. Just haven't fallen yet. So I don't know when the zombies clear. Have you seen zombie opportunities yet, or anything that's really below debt basis, Charlie, that's coming across your world? Or are you just looking at the newer stuff and not even trying to go back to the 70s?
No, we did the deal in San Antonio, but the basis on that at par was fine. But I will agree, those that are way below par. I was with a lender in New York when I made my trip up there, and just talking it through, and they do not think they have a problem, and they do have a problem, and they don't totally realize they've got a problem. So that they're not ready to write things down. They're not ready to be creative about it. For the most part, I've heard a handful of stories of people that are getting some creative opportunities, but as a general rule, that's another reason I was going, okay, if we go to the end of the year before they cut rates, some of those zombies you're talking about will just have to fall down and hopefully create some opportunity. Because I mean, we're good for doing anything that's moderate income workforce housing all the way up.
Any as we kind of wrap this up here, any major takeaways or any kind of stories, because I think it's more, my view is more optimistic than not right now. I mean, I think
Yeah.
we weathered the bulk of the storm. I'll give you my view of the market is, on the class A, probably A minus. I think we probably have bottomed, in valuation. I mean, I think that, we've seen a tremendous pullback from the peak, probably, 25% ish on the well built, well located, professionally managed stuff. Peak got a little crazy. I think, the workforce housing stuff is probably down, 35%, maybe more in some cases, maybe less in some cases. And you got a lot of people that haven't recognized reality. So that market's been kind of frozen. They haven't been forced to yet. And then one day they a segment of that will be forced to. So, you're still seeing some deals trade on the margins, maybe in the 20-25% kind of discount range, but I think there's some more pain to come. And then I think, the moment where the market really starts moving is when we see the Fed rate cuts, institutions come in. I think the Class A stuff gaps up 10% overnight is kind of what I'm viewing. And then workforce is going to be a lot harder to kind of clear out. And a lot of it's got to clear through the lender below debt basis in some form or fashion. And then I don't know how long it stays there. I don't think this is like 15 years ago where it was, 09, 10, probably, 10 was the bottom, probably 11 started seeing some green shoots, and that was 3+ years of crap,
Yeah.
with banks clearing it. So I don't know if you concur with my thoughts or have a different spin on it, Charlie.
Totally concur with every bit of that. I'll tell you, switching gears just slightly to operations. We had a late 20 all of 21, part of 22, we got fat. We got fat on operations because you had so much rent growth that, you could be a little bit sloppy, and now it's tougher. And so we've used it as the opportunity to right the ship and get our stuff back in order. And I think that's been a good piece out of this. I'm going to do my insurance renewal at the end of April, and I think there's a decent chance that we're down somewhere between 5 and 10%,
Lower?
if not, or maybe more. And I'm hearing that in a number of cases starting like right now. So very encouraged by that. And then the other benefit that we're going to get in Texas is your taxes are not going up in 24, because it's going to be based off of whatever they think the assessed values are in January of 24, and that will be as low a point as possible. So we're going to get some relief from that for 24. Not to say that we're not going to have to go fight them over it, but it's going to be hard to see big changes on that, and in a lot of cases get some relief on it. So that's kind of my take on it.
I always like a funny story. Charlie lives on stories. I remember the story you told us about walking a property and maybe finding 2 legs in a dumpster wrapped up in a carpet. I remember Charlie telling a story about going onto a property that he was thinking about buying, or he was just about to buy, and being confronted by the police saying, "You're here for 1 or 2 reasons. You're buying or you're selling.
Which
one
is it?
Which one is it?" And any funny stories in the last, say, year or so, whether it's operations or it's been ownership or it's been raising money, anything you can think of, Charlie, that would bring another chuckle to the audience?
I'm going to go back to the original investors, and I've told this one once before. Since most everybody has had to be in a position of doing some type of capital call. So after that July of 08 debacle, and we didn't get going, I had to do really one of the only capital calls we've ever had to do. And so the 7 investors lived in Snyder, Texas, and they knew I was coming down. And so I go down to one of them had an auto mall. Just go down to his conference room. They all come in, and one of the guys was one of the original old oil wildcatters. He had drilled more holes. Some worked, some didn't. And so they knew I was coming down to ask for money. And everybody sits around the table. Cloyce, the wildcatter, sitting at the end. I began to tell my story, and he goes, "I understand a dry hole." He thought he had lost every dollar. I go, "No, sir. It's not a dry hole in multifamily until we stop drilling. And so in your language, I just need a little bit more multifamily pipe, and that's going to cost each of you $50,000 per share. So I need 600,000 from each of you." He thought about it for a minute. He goes, "I think you need $1 million too." I said, "No, sir, I don't think we need $1 million too." The other guys around the table were not quite as well heeled as Cloyce, and they go, "Hey, Cloyce, if the kid," I was considered a kid back then, "if the kid says it's 600, let's just start with that." We started with the 600, and Cloyce was right. We needed $1 million too. So we clawed back all our fees, acquisition, construction, every management fee we had to cobble together what we needed to get through for the next several years, and we worked it out. And so we sold it after 8 years, going through the Great Recession. They got a 16 IRR and a 3 multiple, and they were thrilled. And that's what makes you lifelong investors.
That's a great story. If people want to get more information about talking to maybe one of your investment people about investing with Madera, what's the best way for people to get more information about Madera?
Madera Residential has an investor portal link. So you could go on to the maderaresidential.com, and there's a link in there somewhere for being able to send in a request for getting investment information. That's the easiest.
That's great. Michael, any final comments for Charlie?
No, appreciate the time, Charlie. And I know we've become friends over the years, competing on this thing or that thing. But always appreciate your thoughts, and think you guys do a fine job, and do it the right way. So I've always kind of admired your company from an outsider's view. So appreciate you taking time to come back on the podcast and share your views of the market. And hopefully we have you on here in 18 months from now. We're having a hell of a lot more fun than we have the last 18 months.
No kidding. It was fun. It was fun sitting around the fire out at your place with a bunch of our types and just swapping war stories. And we've been taking incoming really hard.
Well, maybe we can have a Black Label episode one night after a few soda pops and get some good stories.
Yeah,
absolutely. We can't do it on this public channel, but we certainly can maybe do it with having a couple cocktails around, maybe around the old Capitol Conference, and inviting Charlie to come out and tell some war stories. And I know a lot of people would enjoy listening to those. So Charlie Young with Madera Residential, we certainly do appreciate you spending some time with us today. I mean, we know that you're very busy. Michael Becker, thanks for joining us on your own podcast. We appreciate that. Again, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.